Let's continue with the next, the next slides. Okay, an opportunity cost. That's an example. A paper producing company is planning to replace an old pulp mill that had been bought many years ago for 100,000 US dollar with an automatic pulp mill filtration and drying line. The opportunity cost of using the new machines is the liquidation price of the old one. So would it be included in the cash flow of the replacement project? Would it be? What is the answer? Is this yes or no? Can anyone answer me?
Yes.
Yeah, it is yes. Yeah, yes. Thank you. So that's the eliminate some cost as well. Yeah, this one. I think I asked you this one as well, right? Did I? This one I asked you already, right? So how about this one? When a milk dairy company hires a financial expert to assess whether to invest in a chocolate milk production line, when this expert submitted the appraisal report to the company protested because the expert does not include the consulting cost, which is quite large, in the cost of this project. So who is right? Yeah, I think that we studied this one last time, but I still want to ask you again, who is right? Is the finance expert is right or the company is right? The company? The company did not agree that the consulting cost should be the relevant, the company says that the consulting cost should be the relevant cost cash flow. But the experts say that it is not the relevant cash flow. So who is correct? Who's right?
The expert right.
Okay, correct. The expert is right? Because it is the sunk cost. If you want to invest in the company, if you want to invest in the project, you still have to pay the consulting cost. But if you do not invest in the project, you still have to pay the consulting cost. Okay, so whatever you do with the project, you still have to pay the consulting cost. So the appearance of the consulting cost does not depend on whether you would accept the project or not. So that's why it should not be the relevant cash flow. That's what we talk here. Yeah, the relevant cash flow should be the cash flow. Should be the cash flow which are the result of the project. Yeah, the change in the future cash flows are the result of the project. Then it is the relevant cash flow. Okay, so that one already. Net working capital. In analyzing the projects, okay, analyzing the cash flow of the project, you would work on the net working capital as well. And you already know that net working capital equal current assets minus current liability. Did you study financial statement analysis? Did you study financial statement analysis? Or financial analysis? I'm not quite sure about the name of the modules. Financial analysis.
Yes.
Okay, so who taught you these modules? Who taught you these models, financial analysis?
Dạ cô Nhung ạ.
Okay, so did you try to create the, what can I say, the cash flow statement? You to establish, to try to establish the cash flow statement. And indirect method. In that you start from the income before tax and you make the You try to find the net cash flow of the company. Did you do that? Did you do that? Yes or no? Yes or no? Which one? Which one is your answer? Is this yes or no? Come on. Did you do that before? Everyone? Just give me an answer. Yeah. The only thing I need is just to give me an answer. That's all. It is yes or no.
Em thưa thầy là bọn em chưa học phần này ạ.
Oh, you did not try to do it. Okay. Really? Okay. So let me show you the the financial statement according to the indirect method. Yeah, let me stop that one and I'm going to show you that. Okay. Give me 5 minutes to open the other laptops so I can show you that one better. And you do not want to talk in English while you talk to me in Vietnamese. Come on. Try to talk in English. Okay, so if you did not try to work on that one, then yeah, I'm gonna let you know how to go on that one, then you would understand it better. We are talking about something which is called the cash flow statement. Yeah, cash flow statement, and we have two different ways to establish the cash flow statement. One way is the direct method, and another way is the indirect method. In both ways, we need to consider what we call the, if we start from the income statement, then we have to consider what we call the change in net working capital. Okay, now here, give me 1 minute. Okay, now let me show you that one. Okay, I'm gonna share you the screen and you can see it immediately now. That one, we call it the cash flow statement. Okay. Yeah, I wonder why Ms. Nung did not teach you the cash flow statement. Is maybe she thought that you already know it. When you maybe she assumed that you studied it in the corporate finance one. Yeah, maybe she assumed that you studied in the modules corporate finance one. So that's why she did not tell you anything about it. But now, yeah, I'm gonna show you this one. You can see it here. That's gonna be the cash flow statement in the Vietnamese form. Yeah, this one's Vietnamese form. Okay. Did you see it now? The cash flow statement here. Do you see it?
Dạ rồi ạ.
Okay, you saw it, right? So here you can see that there are two parts. The first one's going to be two methods to establish the cash flow statement. The first one's going to be the direct method, and the second one's going to be the indirect method. And here you can see that in the indirect method, you will start from the earning before tax. Earning before tax. And then you have to adjust the earning before tax with some items as follow. First, depreciation of the fixed asset, just like what we do when we try to calculate the net cash flow of a project. When you calculate the net cash flow of the projects from net income, you have to plus the depreciation I told you already, right? And the reason why that's the depreciation is the cost, but it is not the cash outflow, okay? So it is the cost, but not the cash outflow. So that's why when you calculate the net cash flows from the net income, you have to take the net income plus the depreciation. And then here, you have the other things like interest expense as well. That's what I told you already. And here you have the interest paid. So here you plus interest expense, but here you minus interest paid. But there's something that you see here. Yeah, you see that you have the change in net working capital here, including the increase, decrease in the accounts receivable. Okay, increase and decrease in the inventory. Okay, increase, decrease in the accounts payable. increase, decrease in the prepaid expenses, etc. So that thing we call the change in net working capital. I think you know it already, right? This thing is what we call the change in net working capital. Okay. So for that one, yeah, we call it changes in net working capital. So that's what we study. Yeah, we should know about it. And we are studying this one in the financial appraisals of investment projects. But in fact, you should know about it before, because this one is very important when you want to establish the cash flow statement of a project. Yeah, then you have to consider it. Okay, if you want to establish the cash flow statement of a project, then you have to consider the change in net working capital here when you start from the income statement to find the cash flow. Okay, then you have to consider the increase, decrease in account receivable, increase, decrease in inventory. Okay, account receivable, inventory, accounts payable, and other things. That is the Vietnamese form. So let me open the English form so you would see it better. Here. I just want to let you know that whenever you want to calculate the net cash flow of a project or of a company from the net income or from the income statement, then you have to consider the net working capital. Here, you also have the change in net working capital. Let me show it. Yeah, let me share it. And I think that I should try to paste this to you. Yeah, I can send you the file so you can see it easily. Okay, so you can see the two different methods here. The first method is going to be the direct method. The direct method, you reflect the cash inflows and the cash outflow directly. For example, you have the gain from sales of goods and services, provision and other gains, payment to suppliers, payment to employees, loan interest already paid, etc. By that way, you directly push the cash inflow and the cash outflow here. So you do not need to consider the net working capital anymore. But here, when you start from the income statement, for example, you take the profit and loss before tax here to calculate the net cash flow, then you have to consider the change in net working capital, including the increase, decrease of account receivable, increase and decrease of inventory, increase and decrease of account payable, etc. Okay, so that one, yeah, that one is what we call the changes in net working capital. Okay, that's what we are considering here. Here we call it the changes in net working capital. Okay. So yeah, so that's what I want to tell you now. Now let me send it to you, yeah, both in Vietnamese and in English, so you can understand it better. I'm going to send you through the chat. Okay. Did you receive it?
Not yet.
Okay, not yet, huh? Okay, so I'm gonna send the Vietnamese version and the English version. Yeah, the Vietnamese version and the English versions to you. And you can see almost all the financial statement in this Excel file. Okay. Then you receive it now, right?
Yes.
Okay, so let's be back to the PowerPoint that we are studying. So that's the reason why we have to study the change in networking capital, because it is one important part in the in calculating the cash flow. So here I'm going to show you that one. Yeah, that's going to be the networking capital. So what's going to be the networking capital, and how could you get the you recover the networking capital at the end of the project? It is as follow. The networking capital is the equal to the current assets minus the current liability. And what is the changes in networking capital? The changes in networking capital equal to networking capital this year minus networking capital in the previous year. It would be changes in current assets minus changes in the current liability. Okay, and you got it already. So if there is an increase in the networking capital this year compared to last year, then you can consider it as a cash outflow. However, if there is a decrease in the networking capital this year compared to last year, a decrease, okay, then you can consider it the cash inflow. And how could you recover the networking capital at the end of the project? Because at the end of the project, you assume that everything would be converted to cash. Okay, so there would be no current assets at the end of the project, including no inventory. Okay, there would be no inventory at the end of the project. There'd be no cash, let's say the cash balance at the end of the project. There would be no account receivable at the end of the project, because you would try to collect all the money at the end of the project. Okay, you would not allow people to get the to get the credit anymore. Okay, trade credit anymore. You would collect all the money you have. Then there would be the recovering the net working capital at the end of the project. It is that. Okay, I'm going to show you. I'm going to show you that one in the next exercises. You would see it immediately. Now, another thing is net cash flow from liquidation, or let's say the disposals of fixed assets. You can call it liquidation, or you can call it the disposal of fixed assets. The remaining fixed assets in the final year of the project must be assumed to be liquidated or sold or disposed. Okay, I can call it disposed. That is better. Disposed. Then the net cash flow from selling the fixed assets would equal to the net selling price minus the cash inflow. Sorry, for the corporate income tax on sales of fixed assets. And it also equals profit after tax from sales of fixed assets plus residual value of the assets. So there are two ways for you to calculate this type of cash flow. When we study this cash flow before here, this cash flow and this cash flow, in fact, they are not the complete cash flow. You can say that they are the incomplete cash flow. Okay, they're incomplete. They're not the complete cash flow. They're the incomplete cash flow. Why is this so? Because these items are not enough for the cash flow. You see, when we use this one, we have the assumption already. Yeah, we have the assumption. We temporarily ignore the change in net working capitals, cash flow from borrowing and investment, and the net cash borrowing and investment as well. So that's why you have that kind of cash flow. So we ignore this one. Yeah, and cash flow from liquidation as well. Yeah, there's something that you should put, and cash flow from liquidation. Okay. From borrowing investment, and yeah, and investment is enough. Investment here also mean the cash flow from disposal as the fixed asset as well. Cash flow from disposal of fixed assets. Yeah, I'm gonna put it here as well, so it's easier for you to understand. Okay, yeah, give me 1 minute. Okay, sorry, I've been just got a call from the university, so it has been temporarily out. So here, let me show you. Yeah. You should remember that in that case, in fact, we temporarily ignore something here. Yeah, we temporarily, remember that word. We temporarily ignore the change in net working capital. So that's the thing that we should remember, that in that case, it is not the real cash flow, but we temporarily ignore the change in net working capital. Okay. Change in net working capital is one thing. Cash flow from borrowing is another thing. We did not put it in the cash flow now, but we are going to do it in the future. Cash flow from investment and cash flow from disposal of fixed asset, we did not put it here. So that's why this one is only the simple form. Yeah, remember that. This one is only the simple form of cash flow. Okay, it's not the full form of the cash flow. So that's why I said that, that's the simple form of the cash flow only. It's not the full form of the cash flow. So now it is the time for us to add back everything that we ignore from the beginning. The first thing we should not ignore now is the net working capital, the changes in net working capital. We cannot ignore it anymore. Okay. The second thing that we should add back is the disposal, the cash flow from disposal of fixed assets. Now, how could we calculate that one? The first case just we get the net selling price. For example, we sell a cash flow, we sell a fixed asset and we get $100 million. Okay, but this $100 million is not the real cash you are going to get, because when you get it, you have to pay the tax from selling this one. That's the extra tax. Okay, that's the extra tax you have to pay. So you have to minus the corporate income tax on sales of fixed assets. And the second way you can do it is to profit after tax from the sale of the fixed asset plus residual value of the asset. Now, let's try with this example. A fixed asset has the history costs. You know what is history cost, right? Do you know what is the history cost? In Vietnamese, you know what is history cost, right? Nguyên giá, okay? History cost of $100 million. Expected useful life of 5 years, and is invested in use from year 0 in a project with a period of 4 years. Okay, the fixed assets are depreciated evenly over time. Corporate income tax rate is 20%. Please determine the net cash flow from the sales of fixed assets if the expected net selling price of such fixed assets in the final years of the project is, the first case, 30 million. Second case, 20 million. Third case, 10 million. Okay, so now please try to work on that. I'm going to give you 5 minutes, okay? 5 minutes to work on that one, and then we continue. Okay, everyone, so do you have the result now? Okay, no, not yet. Okay, if you do not have the results, so okay, so let me I think that's, I'm gonna type it here. Yeah, I'm just not gonna be pen anymore. Yeah, just take out the pen now. I'm gonna type it here to let you understand it better. Yeah, the first way to do is just first you have to calculate the net selling price minus the the corporate income tax on sales of the fixed assets. So yeah, so the first thing you should do is to calculate the income. Yeah, income before tax. Before tax from disposer of fixed assets. Of the fixed assets or of fixed assets here. Okay, so what it's gonna be here?
Em thưa thầy là màn hình thầy đang bị dừng ạ.
Oh, really? Okay,
Em
sorry.
sau cái
Is this okay now?
dạ chưa ạ. Sau cái fix access bằng thì bọn em không nhìn thấy thêm được gì nữa.
Okay. So let me check it. Okay, is this okay? I think it's better now. Let me 1 minute here. So it equal to, yeah, I think that it has been freezed. Yeah, it has been frozen. Yeah, that's gonna equal to, now let's the selling price, the net selling price, okay, minus the residual values of the fixed assets. So you can calculate the residual value of the fixed assets before it. So what's going to be the residual value of the fixed assets? Would equal to, yeah, the history cost is 100, okay, and you're going to use this in 5 years, so it's going to be over 5. In the projects with the projects the period to 4 years, so times 4, so the residual value is going to be $20 million. Okay, that's going to be the residual value. And so now we consider the first case, yeah, which is case 1. The case 1. You have the income from disposal of fixed assets going to equal 30 minus 20, which is $10 million. $10 million. Okay, and therefore the net cash flow from disposals of fixed assets would equal to the cash you get minus the tax you have to pay. Okay, and it's gonna equal to sorry, it's 30 minus this one is going to equal to $28 million. Okay, so you saw it now. Okay, but we can use two different ways to calculate that one. That's the first one. You see, the first one is to make the net selling price minus the corporate income tax on sales of the fixed assets. That's the first method, the first approach. The second approach to calculate that one is equal profit after tax from the sales of fixed assets plus the residual value. And let's check if it is correct. Yeah, the second case is to calculate is as follow. That's the second case. Second case as follow. Net cash flow from disposals of fixed assets equal to income. Sorry, the income after tax, which is income after tax is that one. Okay, it's the income before tax minus tax plus the residual value, which is 20, and then it's going to be 28 as well. Yeah, so they are the same. Okay, so you got the same results. Yeah, so that's, so the net cash flow, you can use two different methods to calculate it, and you got the same results. Both of them equal $28 million. Okay, so now please do it for the case 2 and case 3. Yeah, I'm waiting for you to do it. Trịnh Thành Hưng and Trần Bích Nga, yeah, your answer are not correct because you equal 8, 0, and 10. Yeah, you calculate the income, it is correct. Yeah, minus 10, it is correct, but I want you to calculate the net cash flow. Now, who can show you the calculation of the net cash flow for case 2 and case 3? Just do the same. Some people may think that, when the net income, yeah, Trần Bích Nga, I think your net income is incorrect. Trịnh Thành Hưng, yeah, I think your net income is correct. Yeah, 8, 0, and 10, minus 10. No, it's not minus 10. Yeah, I get what you mean. You think that when you have the positive income, then you have to pay the corporate income tax. But when you have the negative income, then you would not have to pay. But it is not true, because please remember that this one is only the income before tax from disposal of fixed asset. It is not the total income. If the total income of the company is negative, then it do not have to pay tax. But if only the income from disposal of fixed asset is negative, only that, and the income from other is positive, okay, then you still have to pay the tax. You get what I mean? You get what I mean? Case 1/4, no, what is that? 28, yeah, 20 and 12. It's going to be 12, isn't it? Yeah, it should be 12, correct? Yeah, your answer is correct. Yeah, the answer from Trịnh Thành Hưng. Yeah, Trịnh Thành Hưng, your answer is correct about the cash flow. Why is this so? Let me tell you why. Okay, you may think that when the net income is positive, but remember that one. Yeah, let me show you again. This one. This one is an example to let you see it, to let you know it immediately. Yeah. Here. You see it now? Do you see anything? Not yet, right? Yeah, I have to share it again. I'm sharing it, but I am not quite sure that you can see it or not here. Can you see it now? Everyone?
Yes.
Okay, you can see it. Nice. You can see the slides, or let's say not the slide, the Excel file, right?
Yes, we can see the Excel file.
Okay, nice. So you see, for example, for this project, you would have the net income from here. You're going to have the net income from operating activity. Okay, that is the net income from operating activity. But then you also have the other income, which is income from disposal of fixed assets. And the income from disposal of fixed assets may be negative. But you may think that, okay, the income from disposal of fixed assets, when it is negative, then you do not have to pay tax. But it is not true. Because why? Because you also have the net income from, sorry, not net income, income before tax from other activity, which is the operating activity here. And the total income here, the total income before tax would equal to the income from operating activity plus the income from the disposal of fixed assets. So even though the income from disposal of fixed assets may be negative, okay, but the tax would not be zero. You would have the negative tax. Why is this so? Because if you do not have this one, okay, then what's going to be the tax you have to pay? You have to pay this amount times 20%. Okay, that's going to be the tax you have to pay. But because of the negative income like that, you would have to pay only that kind of tax equal that one times 20%. Only that one, which is lower. So why this is lower? Can you tell me why? And the difference between the tax here and the tax here, the difference between these two amounts of tax you have to pay equal to that one. You know why? You know why it equal to that one? Can you still see anything? And you can, right? Yeah. Can you understand why? Why this so? Okay, let me tell you why. Because this amount equal to this one times the tax rate, which is here. Can you still see my screen? Everyone?
Có.
Okay.
Yes.
So you see, yeah, this amount equal to this amount, they are equal. So you have to pay less tax because this one would give you a negative corporate income tax. And because of this negative corporate income tax, you would have a lower amount of tax you have to pay here. Do you understand what I mean? Do you understand what I mean in this case?
Yes.
Yeah, you understand what I explained, right? Because sometimes you think that, okay, when the income is the income before tax is negative, you do not have to pay corporate income tax. It is true if it is the total income before tax. If this one, yeah, total income before tax is negative, then you do not have to pay. For example, here, total income before tax is negative, then the tax would be 0. Okay, that's true for this one. But not for this one, because this one is only the income before tax from disposal of fixed assets. Then you would have to add it to the income from operating activity, and it would give you the total income before tax. And if the total income before tax is the positive, then you still have you do not have to pay tax, but you can save the tax you have to pay. Okay, of course you do not have to pay tax, but the tax would not be 0. You can even save the tax you have to pay. You can save some tax here. You can save 703 and 30. And that's why the tax here is lower than the tax you are assumed to pay here, if you do not have the income from disposal, the negative income from disposal of fixed assets here. Okay, so that's what I'm trying to explain to let you understand why we calculate as follows. Now we come back to the slide. Okay, now let's come back to the slide. Okay, so let's come back to the slide here. And that's why I saw some other get the Trịnh Thành Hưng, yeah, he get the correct answer for the net cash flow. The net cash flow in the case 1 is the 28 million dong is correct. Now let's consider the case 2. Okay, the case 2. Case 2. For the case 2, income before tax. Income before tax from disposal of fixed assets would equal to so it's going to be 20 minus 20, which is equal to 0. Okay, then you have net income from net cash flow from disposal equal to thing. Yeah, it's two ways to do that. The first way is to take the selling price minus 0, because you do not have to pay tax. The second way is to take 0. To take 0, which is income after tax, plus the residual value, and the thing you get is going to be 20 million dollars. That's the second case. The second case. How about the third case? For the third case, income before tax is going to be negative. Okay, it's going to be negative. It's going to be negative. But you are going to calculate the negative corporate income tax as well. From disposal would equal to the first way is just to take the money you get minus the tax, but the tax now is a negative tax. Okay. And the second way is to take the income after tax, which is that one, times 1 minus 20% to get the income after tax, plus 20, which is the residual value. And both of them would give you $12 million. Okay. So by both way, you can get that it's going to be $12 million. That's going to be that. Yeah. Just what a pity that I cannot write there. Yeah. I can only write within the slide. Yeah, I cannot write there. The software does not allow me to write there, so I'm gonna do it like that. Okay, so that's gonna help you to understand it better. Okay, so now you understand almost every part of this one. I think I'm gonna take the print screen and send it to chat. Then you can get it better. Then we are going to work on area not exactly a real, but it's a simulated project. So this time only Trịnh Thành Hưng is correct. So Mai Vũ Minh Ngọc, please withdraw your answer. Trần Bích Nga as well, please withdraw your answer, which is not correct. Trịnh Thành Hưng, the first he calculate the income before tax. That's the first, and in the second case, in the first case, is this the income before tax or not? Yeah. No, income after tax, sorry. No, income after tax, and he's wrong as well. Okay. So Trịnh Thành Hưng, please withdraw your answer as well. Your first answer. The second answer is fine, but the first answer is incorrect. So please delete your first answer. Okay, and Mai Vũ Minh Ngọc, please delete your answer as well. Yeah, your answer is not correct for the net cash flow. Okay, so yeah, I have just sent you the solution for this question. And now, yeah, now we are going to continue with that. Yeah, I'm gonna make it smaller because it's big enough now. Okay, and we move on to the two things: liquidation of fixed assets, and yeah, this part is not important, so I'm gonna focus on it later. So what's gonna be the main objective of this chapter? Yeah, what did we study in this chapter? What is the objective of this chapter? We studied different views on the project's cash flow. Okay, there are different views on the project's cash flow, but two noteworthy views are the equity point of view, which is EPV, and the total investment point of view. And you already know what is the difference between them. Okay, what is the difference between the total investment point of view and the equity point of view? Yeah, what are the differences between them? You know it already. Second, when calculating the cash flow of a project, some assumptions are required, and I already explained the three assumptions to you. The first assumption is that the timing of the cash flow, okay, it would be either the beginning of a year or the end of a year. So that's the first assumption. The second is going to be reinvestment of the net cash flow, and the last one, okay, that's the second one, and the last one, the cash flow is going to be the first the timing, second the reinvestment of the cash flow, and what is the third one? Do you remember the three assumptions of the cash flow? What is the third assumption of the cash flow? First, the timing, either the beginning of a year or the ending of a year. Okay. Second, the reinvestment of cash flow. The cash flow are assumed to be reinvested. And how about the third one? Third one should be the disposals of fixed assets, okay, and current assets at the end of the project. So that's the three assumptions of the cash flow. What else? There are three methods of determining the project cash flow: top-down methods, bottom-up methods, and tax-saving methods. And finally, when determining the project cash flows, it is necessary to comply with a number of principles. And I already told you some principles, right? The first principle is what's going to be the first principle? Is going to be the relevant cash flow, okay? The second is going to be the ignore the sunk costs, okay? And other things, other principle we studied already. So that's the main point of this chapter. And I think we can stop this chapter now. Yeah. We can stop it here, and we are going to work on an exercise. Yeah, we can let you understand it better. So yeah, I'm gonna save it here. Let's temporarily stop here, and let's have a let's say 10 minutes. Okay, let's make it what is time now? It's gonna be 9:50 already. So yeah, let's make it 10 minutes. Let's say 13 minutes. 13-minute break, and then we come back. Okay, is this okay for you?
Okay.
Yes.
Okay, so see you after 13 minutes. Okay, so let's continue. I think I'm gonna send you a project and let's start to work on the project now. Can you hear me?
Yes, sir.
Yeah, okay. Give me 1 minute to send you the project now. Okay, so please open the project and let's start to work on that. I'm going to show you the screen, okay, and then you can start to work on that. Did you receive it? Yeah, please download it and let's go on that. Did you receive the file?
Yes.
Did
Dạ
you
em nhận được rồi.
Okay, okay. Why do you want to talk?
Cái Peony Coffee Project đúng không thầy?
Yeah, correct. Why do you want to talk in Vietnamese? Yeah, come on. You can talk in English, right? Yeah, please keep talking in English. It's the way for you to practice. So, oh, what's the matter? I hear some noise. Okay, so let's start to go on the Peony Coffee project. I have just shared my screen. Do I? I think that I share my screen. Yeah, I have just served, haven't I? Okay, it's here now. Okay, now please, I'm gonna give you 5 minutes to read the project, and then we're going to start to work on that. I think you can read on the file you have just downloaded, so I can stop presenting a little bit. We're going to come back to that one later. The best way you can do is to, I think you can open it in your mobile phone. Yeah, and then you look at your mobile phone and your laptop at the same time. So you can work on it better. Yeah, that's a better way to work on that. Okay, so yeah, after reading the slide now, sorry, the problem now, let's start to work on this one by itself. Now let me open the Excel file, and then yeah, we'll start to work on that. Let me share my screen, and then you can see it. You can follow me, okay? Okay, so you can open your Excel file and follow me. You can open the the Word files that I send you by your mobile phone, okay? And then you can look at your mobile phone to work on this one right now. Do you see my Excel file now?
Yes.
Okay, so that's good. So let's start to work on that. That one we call it the input. Okay, the first part is going to be the input of the project. I'm going to make it as the capital letters to make you yeah, you will be able to see it better. So that's the input. I'm going to save the 5. Yeah, I'm going to save the 5 on desktop. Yeah, as the Peony Coffee projects. Okay, I saved it already. So now let's look at the input of the project. The first one, the expected investment term is 10 years. Design capacity is 15,000 ton. 15. So the design capacity, it's going to be 15,000 ton. Okay, so the first one's going to be design capacity. Now what else? The second one's going to be for each ton of coffee bean, 700 kilogram of coffee ground. So 700 kilogram of coffee grounds. So it's going to be coffee ground over coffee bean. It's going to be 0.7, or let's say 70%. It equals 700 over 1000. Okay, so 0.7. Okay, so that's the coffee ground over coffee bean. What next thing is gonna be inventory over revenue. Okay, it's gonna be 15%. Inventory over revenue be 15%. Receivable over revenues 25%. Revenue is 25%. Cash over revenue, cash balance over revenue. It's going to be 10%. 10%. Payable. Payables over revenue. Maybe another 10%. Okay. Yeah. Cats at the first year. Cats of the year 1. It's gonna be $20 billion. $20,000 million. And inventory. No, not inventory, correct. Of the year 1. It's gonna be $32 billion. Which is 32,000 million. Okay, so please go on that. Finish. Yeah, I'll give you 3 minutes to finish the first part of the file, and then we are going to go on the second part. Yeah, I think you already know it, so I'm not gonna share it. Just follow the information from the top to the bottom, and then you can finish the first part. Okay, ready? Finish? Okay, so the first part has been done. Now let's continue. The second part, yeah, the first part of the input has been done. The second part's gonna be fixed assets. Nah, yeah, continue with fixed assets. Machine is imported from Japan. The ship price is H. Okay. Okay. It's gonna be from Japan. The ship price. So we call it the machine. Yeah, machine. And I'm gonna insert the command here. Insert command. You have two different type of import price. Import price. The first part is gonna be the ship price, CIF, ship price, would equal cost plus insurance plus freight. Okay, that's the ship price. And the ship price is the it is the price at the border gate. The importer. Okay, for example, Vietnam imports something from China. Then this price is gonna be the price at the border gate of Vietnam. Okay, it's gonna be the price at the border gate of Vietnam. What else here? The cost plus insurance plus freight. What else you can do here? Cost plus insurance plus freight. And this one is going to be, it is the basis. It is the basis for calculation. Import duty. Okay, so it's going to be, and how about the other price can be the FOB, yeah, FOB price. FOB. FOB, FOB price. And it's going to be the free on board. On board. And that one is the price at the border gate of the exporter. Okay, it is the border gate of the exporter, not the importer. So for example, China exports something to Vietnam, okay, and Vietnam imports something from China, then FOB is going to be the price at the border gate of China, not Vietnam, because it means that it does not include the transportation fee, then the insurance as well. It does not include that kind of thing. So therefore, yeah, because it does not include the thing, then it is going to be it's not going to be the basis for calculation of import duty. Okay, so you have known it already. Now let's continue with this one to calculate this. So how could you calculate that one? I'm gonna insert another command to let you understand it better. Then you have this the history cost of the machine. History cost of the machine. It would equal to the CIF price, okay, plus here the plus are just times 1 plus the import tariff. Import tariff, or let's say import duty, import tariff rate, times 1 plus the what can we call it here? Yeah, installation cost, the installation cost rate. Okay, so that's going to be the way you calculate that one. Okay, so I'm going to give you time to write it down yourself, and then we continue. Finish? Tell me when you finish, okay? Please tell me when you finish. Finish, everyone? Everyone, please tell me when you finish. Did you finish? Come on. Why don't you answer me? Did you finish typing them? Please tell me. Anyone? Finish typing this thing? Yes or no? Hello? What's the matter with everyone? Okay, I saw some answer here. Okay, finish. Okay, you finished. Nice. So let's continue. Yeah, now it equal to 800,000 US dollar. Yeah, you can use comma or etc. Times the exchange rate, which is 73,000 per USD, times 1 plus the machine's gonna be 12% import tariff times 1 plus 10%. Okay, yeah, imports 12%. 10% here is the, yeah, 10% is the correct, 10% installation cost. Okay, and it's 10% of the sum of the SIP and CIF and import tariff. So that's why we calculate as follow. Over 1 million, yeah, 1 million. Okay, yeah, so that's it. Yeah. 266, yes. Okay, so it's gonna be 22,668.8 million dong. Okay, so that's gonna be the machine. History cost of the machine. You can put it as the history cost of the machine and it is okay. And please tell me if you found the same result. History cost of the machine. Okay, then continue.
Okay.
Okay, fine. Then, yeah, history cost of the factory. Factory, what's gonna be the factory? 5 billion dong, which is 5,000 million dong. Okay, and the progression on the factory. On the building the factory is gonna be 40% for the first year and 60% after that. Okay, so that's the factory. Okay, what else? Continue. Land use right. That's gonna be 1,500 million dong because it's 1.5 billion dong. So that's why. Okay, so first part is finished. Now let's move on the price. Okay, so tell me when you finish.
Thầy ơi,
Yes.
cho em xem lại cái note ở chỗ history cost của machine được không ạ?
Here.
Em cảm ơn.
Okay. Then that's the way you calculate this. Because why we have to divide it by 1 million? Because the unit is $1 million. Okay, then tell me when you finish. Finish?
Yes.
Okay.
Yes.
Okay. Now let's continue with that. Okay, so let's continue with this one. Where that? Question, isn't it? I did not see it. It's here already. Okay, so that's now we continue with the price. The price is gonna be the price of coffee bean. Yeah, coffee bean. It's gonna be 16 million dong per ton. Price of coffee ground. Coffee ground is gonna be 40 million dong per ton. Okay, let's say real capacity of the projects. 50% for the second year, 75% for the third year, and 100% from the next year. Okay, from the year 4. What else? Here's that one. You could call it. You should call it real capacity ratio. Yeah, ratio. Okay, so please continue with the price. And next one is going to be raising capitals. Raising capital. Raising capital. Okay, so cash flow from borrowing. It's going to be borrowing 9 billion in the year 0. $9,000 million. What else? Interest rate. It's going to be 15%. The principal is paid equally in 6 years, okay, and started to be paid from the year 2, okay. Raising capital. What else? Depreciation and liquidation. Depreciation and liquidation and disposal. Yeah, disposal of fixed assets. Okay. Useful timeline. Let's just say useful time, useful life of the machine. Useful life of the machine is 15 years. Okay, useful life of the factory is 30 years. It's going to be 30 years. 30 years. Okay. The liquidation price or disposal price over the residual value. That one for machine and factory is going to be 70%. 70% of machine, factory. Of the machine and the factory. What else? Yeah, land use rise 100%. Okay. Last direct costs. Direct costs. Okay, I'm gonna give you some minute to write them down, and then we are going to work on this. After that, I'll give you 5 minutes. Finish?
Yes.
Okay. Oh, you are very quick, huh? Very fast. Okay, now indirect costs, we have the okay, administrative costs of the year. So the general costs of the year. Yeah, let's say 2. Yeah, 2 is going to be $650 million. Oh, yeah, direct is indirect, sorry. Additive. Over coffee bean cost. It's going to be 20% of the coffee bean costs. Okay. Direct labor costs over coffee bean costs. It's going to be 25%. Okay. And finally, the overhead costs. Head costs of the year 2 is gonna be $200 million. Okay, finally, the growth rate of the overhead costs. Overhead costs is gonna be 4%. Okay, so finish that one, direct costs. Next one's the indirect costs. Direct costs. Yeah, the general cost of the year 0, or let's say indirect costs of the year 2, not the year 0, to $650 million. Then the growth rate of the indirect costs, it's going to be 4%. 4% per year. And finally, yeah, corporate income tax. Corporate income tax is going to be 20%. Okay, so now I'm going to give you the time to type all of them. And then I think that time is up. So after that, I'm going to check your attendance. So tell me when you finish. Finish? Everyone? Okay, so I'm gonna. Did you finish? Come on. I'm talking to you. Please tell me, did you
Yes,
finish?
finish.
Okay, so let me save it as the version 1. Okay, I'm gonna save this one as the version 1, and I send you. So after each day, yeah, after each day, I'm gonna save it and as one version, and then send you until it is done. Okay, then we can stop there. Peony Coffee, the name of it, this one is Peony Coffee Project or something. Just turn it off. I cannot find it anywhere. Peony Coffee. Come on, and where did it disappear? Shame, isn't it? Okay, let me find it. Should be somewhere. Yeah, panic. I put it in my document. Oh my God. I thought that I put it here, but in fact I put it in my document. Okay. Okay, see, use a document here. Okay. Penny Coffee Project. Yeah, I'm gonna put it as the version 1. Version 1. Okay, so that's the V1. And I'm gonna send it to the chat. It's gonna be version 1, V1. Okay. Okay, so it has been uploaded to the chat now. Give me 1 minute. Yeah, okay, it has been uploaded to the chat now. Let me download your attendance list as well. Okay, I finished downloaded the attendance list. Now I'm gonna check your attendance, and we did the same as before. Okay, we are going to do the same as before. Let me open the attendance list, and then I'm gonna call your name. Oh no, that's not it, isn't it? Yeah, it is. It's here. Okay. Hoàng Kiều Anh, please. Okay, now you are here. Nice. Ngô Hoàng Anh. Okay, 1. You get 1 reward. Phạm Hà Anh, please. Okay, saw you. Vũ Thúy Anh. Okay, Ngọc Ánh. Okay, Thanh Bình. Okay, saw you.
Thấy con Bình chưa ạ?
Yeah, I saw Thanh Bình already.
Okay.
Diệu Bình, please. Yeah, Diệu Bình here already. Okay. Linh Chi. Linh Chi here, okay. Mai Duyên. Okay, Phương Điệp. Okay, one. Trung Đức. Okay, Hương Giang. Okay. Ngân Hà. Okay. Thu Hiền. Okay, Thế Hoàng.
Có.
No, come on. You forget the rule, right? Okay. Việt Hoàng. Okay, Minh Hoàng. Okay, Khánh Huyền. Okay, Thanh Huyền. Okay. Thành Hưng. Okay, one. Cao Khang. Okay. Hà Linh. Okay, Khánh Linh. Khánh Linh. Okay, Mai Linh. Okay, one. Phương Linh. Okay. Diệu Linh. Okay. Hải Long. Okay, Cao Long. Okay. Quang Minh. Nice. Ngọc Minh. Okay, Kiều My. Hà My 3410. Okay, Hà My 26 tháng 2. 26 tháng 3, sorry. Okay. Bích Nga. Bích Nga, chính xác. Okay, Bích Nga, please. Okay, Bảo Ngọc. Okay, Minh Ngọc. Okay, Khôi Nguyên. Mai Phương. Như Phương. Okay, Trần Phước. Trần Phước. Okay. Ngọc Sơn. Okay, Thanh Thảo. Minh Thông. Hà Thu. Minh Thu. Thu Thủy. Toàn. Hà Trang. Thu Trang. Vũ Hà Trang. Vũ Hà Trang, please.
Em gửi rồi. Em gửi rồi đấy ạ.
Okay, it hasn't come up yet. Nguyễn Hoàng Ngọc gì đây? Okay, Vũ Hà Trang here already. Okay, nice. Nguyễn Hoàng Ngọc Trâm, okay. Trang, okay. Nguyễn Hoàng Ngọc Trâm, okay. Xuân Tùng. Nguyễn Xuân Tùng. No. Okay. Lê Hồng Vân. Okay. Lê Hồng Vân's here, right? Okay. Nguyễn Thị Hồng Vân. Đào Anh Việt. Đào Anh Việt, please. Okay. Phan Huy Vũ is also here. Okay, thank you. Okay, so except for Nguyễn Xuân Tùng, yeah, has been absent for 3 days. Yeah, no one is absent today. Okay, I'm gonna check the attendance list from Teams to be sure that you are not late. Okay, then I'm gonna tell you later. And okay, so have a nice lunch and goodbye. See you next week. Bye.
Thầy, cảm ơn thầy ạ.
Chào nha, chào các bạn.